All right, let's talk about what kind of week this actually is. Because if you just look at the charts or scroll crypto Twitter, it feels like everything is breaking at once. Overnight flash crashes, hundreds of millions liquidated, Bitcoin slipping, headlines about trade wars, courts, the Fed, geopolitics, and suddenly it feels like the market has no floor and no logic. But when weeks feel like this, that's usually a sign that something important is happening underneath the surface. Not necessarily something catastrophic, but something transitional. And those are the moments where context matters more than predictions. So if you woke up this morning, opened your phone and thought, great, what on earth is going on now? You're not wrong for feeling that way. But this isn't chaos for the sake of chaos. This is a market reacting to a cluster of macro forces all at the same time. Welcome back to the channel. If you're new here, I'm Paula. And this is where we talk about crypto, markets, and global macro without the noise, the hype, or the constant price predictions. On this channel, we focus on understanding what's actually driving the market beneath the surface, whether that's regulation, geopolitics, central banks, or broader financial systems, so that you're not just reacting to headlines, but actually building context around what's going on. Before we get into the bigger picture, let's anchor ourselves in actually what happened overnight, because that sets the tone for everything else. Just after midnight, the crypto market went through a sharp, fast liquidation event. Depending on the data source and how you measure the window, somewhere between $600 million and $800 million worth of leveraged positions were wiped out in a very short period of time, with a huge chunk of that happening within roughly an hour. That matters, not because of the number itself, but because of what it tells us about positioning. This wasn't a slow sell-off driven by investors calmly changing their minds. This was leverage being forcefully removed from the system. Positions weren't closed because traders decided to sell. They were closed because the market decided for them. And that distinction is important because liquidation-driven moves behave very differently from fundamental repricing. They're faster, more violent, and often look far more scarier on the chart than they actually are structurally. That's why you'll often see these moves happen overnight, during thin liquidity, when there's less resistance in the order book, and less natural demand stepping in immediately. What's interesting about this particular move is that it didn't come with a single clean trigger. There wasn't one headline that dropped at midnight that suddenly changed the value of Bitcoin or crypto as a whole. Instead, this was a classic case of fragility meeting uncertainty. And that brings us to the real story of this week, because this is one of those weeks where macro, markets, and geopolitics all overlap at once. Trade tensions, central bank liquidity, legal uncertainty, economic data, and political signalling are all hitting at the same time. And when that happens, markets don't move smoothly, they lurch. The first big piece of the puzzle is the escalation in US-EU trade tensions. President Trump's announcement of new tariffs on European imports has reintroduced something markets absolutely hate: the possibility of a prolonged trade war between major economic blocs. Trade wars don't just affect one sector or one country, they ripple through supply chains, currencies, corporate earnings, and investor confidence. When trade tensions rise, capital tends to move defensively. Investors reduce exposure to assets perceived as volatile, and they rotate into things they believe will preserve value in uncertain conditions. Traditionally, that means government bonds, the US dollar, and gold. Crypto, despite all the narratives about being uncorrelated, still sits firmly in the risk asset bucket in moments like this. So when you see equities wobble and crypto follow, that's not crypto failing to be digital gold. That's crypto being treated as a high beta expression of risk appetite. And right now, risk appetite is nervous. But the tariff story doesn't stop there, because hanging over this week is a major wildcard: the US Supreme Court. There's a pending decision on whether the president can legally use emergency powers to impose these tariffs under existing law. That might sound like a technical legal detail, but for markets, it's huge. If the courts block the tariffs, uncertainty clears very quickly. Markets can breathe again because the worst case scenario of an extended trade war conflict gets taken off the table. In that scenario, you could easily see a relief rally across risk assets, including crypto, because uncertainty is removed. If the court allows them, the opposite happens. Markets have to price in a longer period of trade friction, retaliation, and slower global growth. That doesn't mean everything collapses, but it does mean volatility stays elevated. And this is where people often misunderstand volatility. Volatility isn't inherently bearish. It's a signal of disagreement. It means the market hasn't decided what something is worth yet. That's uncomfortable, but it's also how price discovery works. Layered on top of all of this is the Federal Reserve. On Monday, the Fed is expected to inject between $15 and $20 billion in liquidity into the financial system. Now, on paper, liquidity injections are usually positive for risk assets, including crypto. More liquidity means more capital sloshing around, and that capital often finds its way into higher risk, higher reward assets. But context matters. This liquidity injection is happening during a holiday-thinned market, with US equities closed and overall participation lower than usual. That creates a strange environment where liquidity can amplify moves rather than stabilise them. Instead of smoothing volatility, it can actually exaggerate it, especially in markets that trade 24/7 like crypto. That's why weeks like this can feel emotionally exhausting. You have forces that are technically supportive for markets colliding with forces that increase uncertainty. The result isn't a clean trend. It's sharp moves in both directions, failed follow through, and suddenly flushes of leverage like the one we saw overnight. Later in the week, things don't exactly calm down either. We've got key Federal Reserve communications coming up, including the FOMC economic report and updates to the Fed's balance sheet. Markets will be watching these closely, not because they expect dramatic announcements, but because they're looking for tone. Is the Fed still worried about inflation? Is it comfortable with current financial conditions? Is liquidity tightening or loosening at the margins? Crypto markets are extremely sensitive to these signals, even when people don't realise it. When the Fed signals tighter conditions, speculative assets tend to struggle. When the tone is neutral or supportive, markets get breathing room. That doesn't guarantee a rally, but it reduces downside pressure. Add to that a slate of US economic data releases throughout the week. Housing data, GDP revisions, inflation measures, and business activity indicators all feed into the same narrative. Is the economy slowing? Is inflation under control? Is the Fed behind the curve or ahead of it? And then just to complete the global picture, we have Japan. Towards the end of the week, Japan is expected to announce a potential rate hike. That might sound distant, but it matters far more than people think. For years, Japan's ultra-loose monetary policy has been a cornerstone of global liquidity. A shift there tightens financial conditions globally, strengthens traditional currencies, and reduces the appeal of alternative assets at the margin. None of those things on their own are catastrophic, but when they all land in the same week, they create exactly the kind of environment where markets behave erratically. That's why the overnight liquidation event is so important to understand properly. This wasn't the market telling you crypto is suddenly worthless. It was the market flushing excess leverage in anticipation of uncertainty. Leverage hates uncertainty. It can't survive indecision. When traders don't know which way the market is going, leverage positions become unstable very quickly. What's also worth noting is how market behaved during the sell-off. Prices moved down across exchanges in near lockstep, with very little price fragmentation. That tells us liquidity providers stayed active and arbitrage mechanisms held up. In true panic events, you see prices diverge wildly between venues, spreads blow out, and liquidity vanish. That didn't happen here. That's another clue that this was a mechanical deleveraging rather than a structural breakdown. Ugly, yes. Disorderly, yes, but not systematically broken. Zooming out, this is one of those weeks where the market is being forced to confront uncertainty head on. Not uncertainty about whether crypto exists or whether the technology works, but uncertainty about macro conditions, politics, and global coordination. And that's where perspective matters most. Markets don't fear bad news as much as they fear unclear news. Clear bad news can be priced in, unclear outcomes create hesitation, and hesitation creates volatility. This week is dominated by unclear outcomes. Trade policy could go either way, court decisions are pending, central bank tone is being scrutinised, global liquidity is in flux. That doesn't mean you should panic, it means you should expect movement. For long-term holders, weeks like this are about emotional discipline. The fundamentals of the space haven't changed overnight. Adoption hasn't reversed, infrastructure hasn't disappeared, but price will still move in ways that feel uncomfortable. For traders, this is a reminder that volatility cuts both ways. There is opportunity in movement, but only if risk is controlled. Overnight flushes like the one we saw are brutal for anyone overextended, but they also reset the playing field. And for everybody watching this from the sidelines, this is one of those moments where understanding context gives you an edge over reacting to noise. This isn't the market falling apart. It's the market adjusting to a dense cluster of macro uncertainty. And once that uncertainty begins to resolve, whether positively or negatively, price will follow structure again. The biggest mistake people make in weeks like this is assuming every sharp move must mean something existential. Most of the time, it doesn't. Most of the time, it means the market is recalibrating. So if this week feels intense, that's because it is. But intensity doesn't equal collapse, it equals transition. If you want to understand how we navigate weeks like this, not just when the markets are euphoric, but when they're messy and political and macro driven, we've put together a completely free course that breaks down how we think about risk, structure, and uncertainty across different market conditions. You'll find the link in the description below. And as always, if you're holding crypto long term, self-custody matters. I use Tangent personally, and I've linked it below with a community discount. If this helped you make sense of what's going on, make sure you like the video, subscribe to the channel, and let me know in the comments how you're approaching this week. Are you sitting tight, trading the volatility, or just watching from the sidelines? Thank you so much for watching, and I'll see you in the next one.